Hi students. In the last video, we looked at the accounting equation. Assets equals liabilities plus owner's equity. Today, we're going to continue with a look at the expanded accounting equation. And we're going to look then specifically at things that cause owner's equity to increase or decrease. Now, you could relate this to your own life quite easily. In the last video, we said, well, what if you did a personal balance sheet and you've got your assets, your liabilities, and your net worth? Well, if you work for a living and you earn a couple of $1,000s, then you have probably more cash in the bank and you have no more liabilities than you had before. So your own personal equity went up because you earned money. But if you take some of that money and you have to pay your electricity bill, let's say your electricity bill is $60. Well, you already used the electricity and now you've been billed for it. So you pay your own money to pay the electricity bill. Your assets go down with the payment of cash. Your liabilities didn't change, yet your personal equity went down because you paid an expense. So similarly in a business, when a business earns revenue, I'll just look at this, we earn revenue, the net effect of earning revenue is to increase owner's equity. So let's just say that we have a service business and we provide services for $200. Well, what's going to happen is that when the person gives us the $200, we're going to have more cash. And as we looked at last time, cash is an asset with a debit balance side and a debit increase side. So if cash goes up, then cash goes up with a debit. Now, we don't want to say owner's equity goes up at this point because we want to keep track of all our revenues for a period of time, usually at least a month. So instead of saying, oh, look, my owner's equity went up because I earned revenue, I'm going to keep track of that revenue separately in a revenue account. And in this case, I would probably use an account called service revenue. And my service revenue will eventually increase owner's equity. So as we earn revenues, those become a credit. Notice that this transaction would give us a debit to cash and a credit to a revenue account. So here's a credit to my service revenue account. Now, if we did that 10 more times, then every time we earn revenue, the service revenue account goes up and up and up with more credits. And maybe at the end of the month or even the end of the year, we add those up and we allocate them to the owner's account or the owner's equity so that the credit that is there is a credit for two reasons. First, we know that every transaction needs a debit part and a credit part that are equal. We know we've debited cash to increase it, so we have to have a credit on the other side. But the other reason it's a credit is that it causes owner's equity to increase. And we know from the previous video that owner's equity increases with a credit. So that's why revenues are credits. Now, what causes owner's equity to decrease? An expense. So we might say, well, what's an asset and what's an expense? Well, remember, again, in the last video, we talked about an asset as something you own or control that is probably going to provide you with a future benefit. An expense does not provide you with a future benefit. You needed to pay it to run your business, but it's in the past, so there's no future benefit. That's what makes it an expense. So let's think of some of the things that would be typical of an expense. We just talked about an electricity bill. So we might have electricity expense. Notice that you use your electricity for 1 or 2 months and then you get billed for it. You've already had the benefit of using the electricity in your business, so it has no future benefit. You're just getting the bill. So now it's an expense. Let's say you have a few people working for you. Well, they work for you, let's say for 2 weeks, and then you pay them. So that's an expense as well, because you already received the benefit of their work, but now you're paying for it. So that's an expense. We could also look at other utility bills. We could look at your insurance. So let's say you buy insurance for your business and you let some time go by. So let's say you bought a 3-month insurance policy for $1,000. Well, 3 months goes by and you've used up that insurance in your business. So after 3 months, it's all an expense. Now we're going to get into that in a little more detail in a future video, an expense that, kind of incurs over a period of time. But for now, let's recognize that when you incur an expense, you are usually paying for that expense with an asset such as cash. So cash will go down and your expenses are therefore a debit. Now let's look at another reason. Owner's equity decreases with a debit. And we know that an expense decreases owner's equity. The same thing as you having an expense in your personal life decreases your net equity, in your own sort of assets and liabilities. So, in your own household. So when we go to journalize this, let's say we have a $100, I'll take a $100 gas bill. So we're going to pay that gas bill. We've already used the gas, and that's how they know how much to bill us. So we're going to pay it with cash, and the gas bill is an expense. So we're going to go, I'm just going to use gas. There's probably a better word, but we'll just call it gas expense. We're going to debit gas expense for the $100. And notice that the expense is a debit because it causes owner's equity to go down. Now, we're paying for it with cash. So my cash goes down and an asset decreasing is a credit. Now we're going to look at how to prepare the actual journal entry for this in a couple of other videos coming up. And in a future video, we're going to look at a lot of examples of how to prepare a journal entry in exactly how to do it. So for now, I'm not putting in the numbers. What we're looking at today is our expanded accounting equation and looking at how primarily revenues and expenses affect owner's equity. Okay, so let's just look at a couple of other little things here. And these are actions of the owner. So let's say the owner invests his or her personal money. Now we did this in the previous video, but we'll look at it again. If the owner invests personal money into the business, then here's cash going up with a debit, and the owner's equity goes up with a credit. Now, the opposite happens if the owner draws money out of the business. So let's say you've had lots of revenue, not too many expenses, and you have lots of money in the bank, in the business, and the owner says, I'd like to have some money. So the owner might decide to withdraw cash from the business. If the owner takes cash away from the business, that's an asset going down. So we decrease cash. But if you take that asset away from the business, it's not part of your business equity anymore. You're putting it into your personal bank account. So that also decreases owner's equity. So that we can see a withdrawal of an asset from a business decreases both assets and owner's equity, whereas an investment into a business increases assets and increases owner's equity. So that's a look at the expanded accounting equation. And as I mentioned, in a future video, we're going to do lots of practice so that you can become more adept at preparing journal entries and figuring them out.